Can I welcome you all to this important event? It's the 103rd meeting of the Mile End Group, and the Mile End Group is an institution which just keeps on giving. And can I take this opportunity? It's always important to mention the sponsors, and the Mile End Group has some seriously committed sponsors. Hewlett-Packard, City of London Corporation, and the School of Economics and Finance and the School of History. Can I also remind you that all of this evening's proceedings are on the record. So, you know, if you are planning to stand up and denounce the Bank of England, it will be streamed, if not live, to Bloomberg. It certainly will be recorded and available afterwards. But we are here to listen to David Miles, which is a huge privilege. David is one of the nation's leading economists, certainly a very leading monetary economist, got extraordinary experience, works across government, academia, even worked for Morgan Stanley, but got out just at the right time. I should declare an interest, actually. At the heart of the crisis, I did try and recruit David to come to work at the Treasury, be one of Alistair Darling's leading economic advisors, but sadly, David showed very good judgment and chose to join the Monetary Policy Committee of the Bank of England instead. And, you know, the Treasury's loss was the bank's gain. And, you know, I often wonder why he made this choice, but perhaps it had something to do with the rate of pay. The Treasury finds it very difficult to compete in any market. Anyway, David made absolutely the right decision because he has been a pillar of the Monetary Policy Committee at one of the most extraordinarily difficult times in the history of monetary policy. I think it's fair to say he's been at the dovish end of the spectrum, but he will no doubt speak for himself. He is speaking on a subject which should be dear to all our hearts in the coming period, which is all about uncertainty and the transition to a new normal for monetary policy. David Miles.
Thank you very much, Nick, for those very kind and largely accurate words. I'm going to speak for no more than about 30 odd minutes because I'm very keen to leave quite a lot of time to hear people's thoughts and views on what I'm going to talk about. And what I'm going to talk about, and the question I'm going to address, is in many ways an extremely simple one. The question could be posed in just a couple of words, which is this. What might be the, what you might call the new normal for monetary policy? And let me put that question at the outset slightly more precisely. What I mean is the following. The question is, what level of bank rate, the rate set by the Bank of England, what level of that rate might one expect to be a neutral level? In other words, a level such that if you started from a position where the economy was in what you might call an equilibrium, so that demand was in line with supply, there wasn't excess unemployment, there was no excess slack in the economy, so the real economy was in what you might call an equilibrium, and inflation was pretty much at the target level, 2% in the UK for CPI inflation, then what level of interest rate might you expect the central bank, the Bank of England, to then set so as on average to expect that you could stay in that position with inflation roughly at the target level and with demand in the economy evolving in line with supply, so that the economy was neither overheating nor creating slack because demand wasn't strong enough to keep pace with the productive potential of the economy. Now that's a position, i.e. a position of what I'm going to call that a neutral position for monetary policy. You might call it an equilibrium position for monetary policy. The names don't really matter as long as we're clear about the concept. And as I say, it is what is the neutral position for monetary policy once you've got back to what you might call an equilibrium position. And that clearly is not the position that the UK economy is in today. And it's very clear that the level of monetary policy, the setting of monetary policy, is very much not a neutral setting at the moment. Bank rate at the lowest level in 320 years since the Bank of England was established in 1694, and the bank having accumulated a huge quantity of assets under the asset purchase programme, goes by the sort of horrible jargony name of quantitative easing. But whichever way you look at it, the setting of monetary policy at the moment is clearly not neutral. It's not normal. But the question is, when we get back to a more neutral setting, what might monetary policy look like? Oh, incidentally, I said I would talk for about 30 odd minutes. I generally underestimate how long I'm going to talk for. But I am very happy for people to interrupt as I go along, actually. I quite enjoy that. So if people want to interrupt or heckle or give words of encouragement or make disparaging comments, I'm absolutely fine with that. The answer to that question, what might be the neutral level of bank rate, may to some extent depend on what happens to the balance sheet, the size of the balance sheet and the composition of the balance sheet of the Bank of England. A balance sheet which has increased enormously since the financial train wreck and is now some 4 times larger than it was before the financial disaster. But for the moment, I'm going to set aside that question about what's the interaction between the level of bank rate you might expect us to get back to and what the size of the balance sheet of the Bank of England is. Because I think actually the questions are separable, and I'll offer a few thoughts on that a little bit later. But I want to start with that fundamental question then about what might be the neutral, the normal level of bank rate we might hope to get back to at some point down the road. I used to think that that level was probably around 5%. 5% was the average level of bank rate between the period when the Monetary Policy Committee was established in 1997 and the eve of the financial mess, 2007. And that was a period, that 10-year period, was a period over which inflation, not just on average, was close to the target level that was given to the Bank of England to hit, but actually at no point did the inflation rate deviate by more than a rather small amount from the target level. Furthermore, at least at the time, it seemed as if the real economy was in some sort of equilibrium, neither overheating nor generating excessive unemployment. So it looked like that was a 10-year period where inflation was very much in line with the target, and supply and demand in some sense were in balance with each other, in the sense that there was no obvious signs of the economy persistently overheating or generating lots of slack because there weren't enough jobs for those that wished to work. So if you ask the question on the eve of the financial crisis, what's a neutral level of bank rate? My answer would have been about 5, and I suspect that most economists would have said about 5 for a neutral level of bank rate. Incidentally, 5 is almost exactly the average level of bank rate in the 320-year period since the Bank of England was established. There's the history of, I've called it the policy rate, because the rate that the Bank of England sets has not always been called bank rate. But there's the history of it. This looks like it might be some glitch in an Excel program that has accidentally given you the same number for 100 years. That is not a glitch. It is indeed the case that the policy rate set by the Bank of England was unchanged for 100 years. And as I've observed a few times before, if there had been a Monetary Policy Committee then meeting once a month, they would have had 1,200 meetings at which they decided, on balance, things were going so well with interest rates at 5%, then why should they change a winning game? Actually, during much of that period, there were usury laws, which actually meant that interest rates really couldn't rise above 5%. So it's a little bit of a distortion in a way. But the average over the whole period, that 320-year period, is indeed 5%, or very close to 5%. And as it happens, if you were to measure inflation over that 320-year period, it's to a couple of decimal places, 2%, as far as I can make out. So if you looked at just the 10-year period before the financial mess, or you went through the whole 320-year period, you might well come up with the same idea, that 5% is a sort of normal level of the policy rate set by the Bank of England. I think there are some pretty powerful reasons, though, for believing that now that normal rate is probably below 5%, and possibly significantly below 5%. And I want to spend most of the time this evening thinking through some of the reasons for believing that, if you like, the new normal for bank rate may well be a number significantly lower than what we used to think of as normal, which may well have been around 5%. So one way, somewhat simplistic way of thinking about what the policy rate that the central bank might set is to say that it should be the sum of two components. One, a real rate of interest, a short-term, real, safe rate of interest, plus whatever the central bank thinks is acceptable as a rate of inflation on average to achieve. So if you thought that the safe real rate of interest should be a number that is quite likely to not be generated just by actions taking place within the UK, but is in some sense a world global capital market clearing concept. I'll come back to that idea in a moment. But if you thought of that number as 3% and you had an inflation target of 2%, that would generate a rough and ready assessment of the neutral policy rate that the central bank might set of about 5%. Why focus, I mentioned a few times, safe real rate. By a safe real rate, I mean the real rate of return after inflation that you might expect to earn for a relatively short-term investment. Why is that number relevant to a central bank? Well, in part because the rate that the central bank sets is itself a safe rate. I mean, bank rate in the UK is the rate that the Bank of England will pay on reserves that the commercial banks can hold at the Bank of England. And we guarantee to pay it, and since we can create money, we probably will pay it. So that is as close to a safe rate as you could hope to get. And that's why I think there are reasons for thinking about the safe real return on assets plus the acceptable inflation rate as one way of getting a handle upon what might be a neutral level of the rate set by the central bank. And measures of what that safe real interest rate, that is inflation adjusted, a real rate of return that you might expect to get on a safe asset, estimates of that across the world have actually been on a declining trend for quite a substantial period. This chart shows an average of the real return that you can get on safe assets issued by various governments around the world. The UK government has been issuing inflation-proof debt, index-linked bonds, for, almost since the early 1980s, so 30-odd years now, and several other countries now issue index-linked debt. And this chart shows an average of the real interest rate that you would get, and it's pretty much a safe rate because it's guaranteed to compensate for whatever happens to inflation. And these are bonds issued by the UK government, the French government, the US government who are very unlikely to default on their obligations. So if you were trying to measure a safe real interest rate that's available in the world, I think the best you could do is look at inflation-proof or index bonds issued by the major countries. And this chart shows the average of those real interest rates over time based on the yields on 10-year debt. And you can see a fairly substantial decline over the last 30 years or so in those yields. Around about 4% in the 80s and 90s, dipping down to perhaps 3% by the year 2000, a little bit lower before the financial crisis, but then moving down really quite sharply in the aftermath of the financial crisis. In fact, this is an average of those real interest rates on bonds issued by different countries. If you just focused on the yields on UK government debt, which is probably the most relevant number if you're thinking about what is a safe real rate on a sterling, a UK currency investment, those 10-year yields would be lower again and pretty much at zero. In fact, another way to address the issue of what might be a measure of short-term real interest rates is to focus not perhaps on 10-year yields, but to work out what the implied shorter-term real interest rate on debt some way down the road is. So this chart, which is simply based on gilt yields, UK index-linked bonds, looks at so-called forward rates 10 years ahead. What does that mean? That is a measure of the real interest rate that people, in some sense, are expecting to be the rate in the UK economy, looking not over the next few years, where we still have a very unusual monetary policy, but looking beyond that to a point 10 years ahead, when it is likely that we will return to something more normal in terms of monetary policy. Now, it may well be a new normal, but it's probably a more normal situation for monetary policy. And you can see that that rate, actually the evolution of that number is rather similar to the previous chart, on a declining trend, flattening off in the years leading up to the financial crisis, but dipping down really quite sharply since the financial crisis of 2008. Now, that's one reason for thinking that if this phenomena of unusually low real interest rates were to persist, and you took this number and added on an inflation target, which in the UK is 2%, you clearly would end up with a smaller number than if you'd done that calculation 8 or 9 or 10 or 20 years ago. But the key question then to think about, I think, is whether or not this decline, and this particularly sharp recent decline, is a transient phenomena that will not persist, or whether this really is the kind of new normal level of safe real interest rates in the UK. And there are plenty of explanations for why we have seen this longer term trend downwards. One is that there may have been an increase in the overall supply of savings in the world as economies that were in some sense cut off from the global capital markets became part of the global capital markets, countries which may have a high savings rate. China is the obvious example. And that's a plausible story perhaps for the declines particularly sharp over this period back there. Of course, whether or not those very high savings rates in China in particular will persist is itself far from clear. It may well be that levels of consumer expenditure in China will increase much more rapidly over the next few decades than they have in the past. That would drive the savings rate potentially down. It's also the case that the demographics of China will change very substantially over the next few decades. That may well also mean that the savings rate declines. So if you think that part of the story for this 20-odd year decline in what I've called safe real interest rates is to do with global savings trends, then it may well be that those trends do not prove permanent, and that the global savings rate may actually be heading in a different direction over the next few decades. I'm also less clear that the most recent and really rather sharp decline since the financial crisis really is to do with these longer term trends in savings. Another possible story is that if people expect the average rate of growth in the major economies to be slower over the next 10, 20 years. That may be a reason why the safe real interest rate is lower. Why so? Well, a simple bit of economic theory might say that if you expect your future wealth and income to be slightly lower, as it would be if you go from a world thinking that growth will be 3 or 4% to a world in which you think on average annual growth will be 1 or 2%, if you think your future self will be less wealthy, you may well decide you need to save a little bit more. And if that's true across major economies in the world, that's a shift in the overall amount of savings, and that would tend to drive down the real interest rate. If more people are prepared to save and less prepared to borrow, that would make the equilibrium interest rate a bit lower. And that's a story which may have some force. I'm less convinced, and in fact I'm less pessimistic than those who take the view that we must now get used to much lower growth rates right across the advanced economies. There are many very eminent economists who think that we should expect growth to be much lower in the future. I'm not convinced by all the arguments that are put forward, and I also, once again, I'm not convinced that that may be the best explanation of this recent sharp downturn. And I'm going to focus on one factor which I think has been a significant force in driving real interest rates down lower, and which, crucially, for the question we're addressing this evening, I think will be a persistent factor. And that is a change in the perceptions of the degree of risk in the global economy. It seems to me highly likely that having gone through a period in the back end of 2008 and early 2009, when the banking systems in many countries came close to total meltdown, and when the decline in GDP in many countries was on the same scale as we saw during the Great Depression, and here in the UK, when after that the recovery until very recently has been all but non-existent, that combination of events, many of which seemed inconceivable to most people in 2006 or 2007, the fact that they did happen, I think has had an impact on people's assessment of how risky both the world economy is and the economy here in the UK. And I want to spend a little time sketching out an economic argument as to why, if it is indeed the case that people now think that there is greater risk of occasional but extremely bad economic outcomes, that is likely to have a very substantial impact on what I have called the safe real interest rate. And that in turn has a first order and significant impact upon what we might think of as the neutral rate of interest that the central bank should set, the level of bank rate that we should expect in the UK when we've got back to a more normal situation. And I want to sketch out an argument which was laid out, I think, rather clearly in a nice piece of economic analysis by Robert Barrow, the American economist, about 5 or 6 years ago. And I've done a little work on the analysis and tried to generalize his argument a little bit. And let me just spend a few moments explaining what all that is about. Barrow said that if you want to explain the history of the variability in economic activity across a large number of countries and across a long period of time, not the 20 or 30 years that most economists tend to focus on, the last 20 or 30 years when they're thinking about how the economy works, but going back hundreds of years, in fact about 200 years, and using a large sample of countries, his argument was that you had to then take seriously the proposition that there were substantial probabilities that every few decades there was an economic event which is extraordinarily bad for many economies. That if you assumed, as many economists do instead, that the range of outcomes for economic growth follow a nice, steady, normal distribution, where most of the time you're close to the mean outcome and there are very small probabilities of being a few standard deviations away from the mean, in terms of the growth of GDP. He said that was a hopeless model. That was a hopeless model in trying to explain the evolution of economic activity across countries and across many decades. And he's absolutely right. I'm not going to show you too many tables, but here is one. And bear with me while I briefly explain what this table shows. Take a large sample. I think I've taken about 50 countries. So countries that are now the rich countries, countries that people used to think of as definitely going to become very rich, but never quite made it. Brazil perhaps would be an example of that. I've taken a large sample of countries and looked at the annual percentage change in GDP in those countries over a long period, about 200 years. And we can then plot the frequency with which on occasions GDP fell by large amounts, by 5% a year, or 10, or 15, or 20%. And the number of times in which GDP actually fell. Obviously, that's much more common. It's not that rare to have GDP from one year to the next actually fall. If you fit a normal distribution to the data and fit it as best you can, you would be led to believe that the frequency or the probability of events like GDP falling 15% or 20% is extraordinarily low, much, much lower than the actual frequency of those events historically. So for really big bad outcomes, let's take GDP falling by 20% or a bit more, the normal distribution would say that that's a sort of 1 in 1,000 year event, actually 1 in about 2,000 year event. Well, actually it's occurred about once every 200 years. So it's quite rare, but it's nowhere near as rare as you would anticipate if you thought things followed a normal distribution. So instead, Barrow suggested, and I've tried to estimate this empirically, what you should think of is that most of the time, the outcomes for economic activity do follow a nice standard normal distribution with very low probabilities of extreme outcomes. But every now and again, maybe it's only every 50 or 60 or 100 years, but every now and again, something happens that could knock 20 or 25% off the level of GDP. Now, you might say, well, okay, maybe that's true for some countries, but an advanced, functioning economy like the UK, that doesn't happen, does it? Well, I think it probably does. I think we may have lived through such an episode. I mean, the level of GDP in 2009 fell by about 5 or 6%, not the 20% I've talked about here. But after that, instead of the level of activity bouncing back, we had, on average, virtually no growth for the 4 or 5 years after that. So if you take the fact that you might, on average, expect the UK level of GDP to grow by 2.5%, and it fell by 5 or 6 and then didn't do much for a few years, cumulatively, you've knocked maybe 15% off the level of GDP. The level of GDP in the UK now is probably somewhere around 15%, maybe slightly more than 15%, lower than you might have expected if economic activity had just followed a nice normal, typical path from 2007 to today. So I think the event that we've been through, the financial crisis, it qualifies as being one of these extreme events which you might expect to be once in a 1,000-year type event, but actually when you look at countries over long periods of time, turns out to be much more common than that. So what, you might say, well, what's that got to do with the safe real interest rate and the policy rate that a central bank might set? Well, here's the link, I think. If you are in a world in which people realize that there is a non-trivial probability, a quite substantial probability of economic outcomes that are very bad, and where the rates of return they might expect to get on risky assets, equities, corporate bonds, might be very poor, but that there is an asset that is likely to generate a safe return, an index-linked bond, for example. If people perceive that that risk of very bad outcomes is large and has gone up, then the demand for the very safe asset is likely to be higher. And what that will mean is that the real rate of interest on safe assets will tend to go down because people value them more because they're a hedge against these extremely bad outcomes. And the neat thing about the analysis done by Robert Barrow was that he thought of a way of calibrating how powerful and significant that effect may be. And I want to show you a table which, I'm going to skip ahead a little bit here. I'm going to show you a table constructed from the model that Barrow developed. And in the paper version of the talk I'm giving this evening, which is on the Bank of England website now, for those of you who are interested, there's a kind of annex which sketches out the economics of how all this works. I'm not going to focus too much on the technical details, but I'm simply going to show you the results of a thought experiment, if you will, using this economic framework. So what I've done is the following. I've asked the question, let us suppose that you are in a world in which people believe that the chances of very bad economic outcomes, things that might knock 20% off the level of GDP or more, let's say people thought the chances of those things happening in any 1 year was 1%. So they were 1 in 100-year events. But then something happens, the financial catastrophe and crisis we've been through. And people think, actually, that may well not be a 1 in 100-year event. Maybe it's a 1 in 50-year event. So you double your assessment of the probability of that kind of awful outcome occurring. If it's a 1 in 50-year event, you might hit 2 of them in your life. If it's a 1 in 100-year event, you might only see 1 in your life. So, you know, it's a material difference in the probability of the event. What would one anticipate that does to the equilibrium return on an asset that was safe and guaranteed you a real return, like an index-linked bond issued by a government that even through a financial crisis was going to continue paying its bills? Answer depends a bit on how bad an event we're talking about. If we're talking about an event that, if it happened, might knock 20% off the level of GDP, then doubling your perceived probability of that from once in a 100-year event to once in a 50-year event could knock about 1.4% off the yield. That's a pretty big number. If you think of the chart I was showing you earlier about yields on 10-year index-linked bonds, they were 3 or 4% a few years ago, and they've dipped down just before the crisis. They were probably around 2, and right now on UK index-linked gilts, they're not far off 0. So a 1.5% or 2% decline is very material, and it's about what we have seen in the yields on these safe real assets. If the events that we're talking about and whose probability people might have assessed to have increased are even worse than an event that knocks 20% off GDP, then the value people attach to a safe asset is even greater, and the yield on that safe asset goes down even more. So if you thought that things could happen that could knock 35% off GDP, and they go from being 1 in 100-year events to you're thinking maybe they're 1 in 50-year events, well, that would almost certainly take the real yield on safe assets into negative territory, because it might knock off the order of 4% off those yields. So the lesson I take from these are simple calculations based on models that make all kinds of simplistic assumptions, but I think it's helpful sometimes to just get a handle on orders of magnitude. And the lesson I take from these bits of analysis is that the impact on a safe real interest rate of even relatively small changes in perceptions of very bad events can be very material and large. May have knocked, 1% or even 1.5% off safe real interest rates. I think there is another and in some way related way of thinking about the drivers of equilibrium or neutral levels of policy rates set by the central bank, which focuses not so much, as I've been doing so far, on what may have happened to the safe real rate, but what might have happened to the spread between what you might call a safe rate, and certainly the rate of interest that the Bank of England sets is a safe rate, the spread between that and the interest rates that really matter in the economy, which are riskier rates. They're rates of interest that people might charge in order to induce them to hold corporate bonds, where there clearly is more risk than somebody who's got a reserve balance at the Bank of England. Or indeed the rates of interest that banks and building societies may need to charge on mortgage rates. The spread between those rates and a safe rate such as the rate set by the Bank of England, I think, is likely to be driven by the same sort of factors we've been focusing on here, namely perceived risks of bad economic outcomes. And those spreads, that is, the spreads of interest rates in the wider economy over the safe rate set by the central bank here, bank rate, certainly have increased markedly. Let me show you a picture of some typical interest rates faced by households and firms in the UK relative to bank rates. So this dark bluish line here is bank rate cut to 0.5% almost exactly 5 years ago, March of 2009. And these other interest rates are various interest rates in the economy. So the turquoisey one there, household secured borrowing rate, that's an average rate on new mortgage lending in the UK. And you can see that in the 10 years or almost leading up to the crisis, the spread between bank rate and the average interest rate charged on new mortgage lending was very small. Not only did those rates move very closely in line, but the spread between them had fallen to unusually low levels. The corporate borrowing rate, that's this one, that's a yield on a corporate bond, also tends to move very closely in line with bank rate. The spread on average was a little bit bigger than that between mortgages and bank rate. And clearly those spreads increased very substantially, which is another way of saying that those interest rates that really matter in the economy to households, to corporations, did not fall by anything like the same extent as bank rate. So that those spreads have moved to levels which are very substantially higher than they were before the financial crisis. Now, one question which I think is central to the issue about what might be the new normal neutral rate for the central bank is what might happen to those spreads in the future. I think one of the reasons why those spreads have increased is that there is a greater perception amongst people who are financing lending to the household and corporate sector on risks. And I suspect that the perceptions of the scale of risks will remain higher than it was in the years leading up to the crisis for many years to come. So I think there's one reason why you might well not expect these spreads to move back to the very low levels, even as bank rate itself moves up to a more normal level. I think there's another reason which is not just to do with perceptions of risk now being greater than they were, but it's that in many cases I believe that these spreads, even adjusting for risk, were at unsustainably low levels in the period leading up to the crisis. Here is one indication of that. What I've done here is to try to roughly estimate what the spreads were on mortgages and on corporate bond yields over government bond yields. So think of government bond yields as a measure of the safe rate. The spread over them is the corporate bond yield minus that. So here, if you like, is the spread over a safe rate for corporates, the spread over a safe rate for the most important component of lending by the household sector, which is mortgages. And those spreads in the 10-year period leading up to the financial crisis were very significantly and markedly lower than on average in the 50-odd years, almost 60 years prior to that. So in the mortgage market, that a spread which used to be significantly in excess of 1%, 1.2% was the average over the 60-odd year period up to the end of the 1990s, fell to 0.5% or so in the 10 years leading up to the crisis. The spread on corporate bonds had also fallen relative to where it had been before. Now, those spreads in the period over the last 5 years, those spreads have increased very markedly, and indeed to levels which were higher than the longer run average before you get into the late 1990s. And where we are right now is that those spreads have indeed come back down. They're still a little bit higher than they were in the 60-odd year period up to the mid-1990s. and markedly higher than they were in that 10-year period, 97-2007. My guess is that these spreads were, even adjusting for risk, unsustainably low, particularly in the mortgage market. And I suspect that the spreads that we might expect, both in the mortgage market perhaps and on corporate borrowing rates, over what you might call a safe rate, will be much nearer to the average over that 50-60-year period than they were in that specific 10-year period, 97-2007. And if that is true, then other things equal, you would expect the neutral policy rate set by the central bank, the Bank of England, to be lower because of that. If that spread, which had fallen to very low levels, is now going to be perhaps 1.5%, 2% even now, and it used to be 0.5%, then the level of bank rate for any given cost of mortgages is going to be that much lower. So I think there are reasons, and I think the two phenomena I've been talking about, this is about spreads over safe rates. Earlier I was focusing on the level of the safe rate itself. I think have both been driven down by common factors to some extent, which is increasing perceptions of how risky the world is. Perceptions which I think will prove to be fairly persistent. Certainly I believe that the scale of the economic shock we've been through over the last few years is something that people will not forget quickly. And I think there's some indication that if you look at market expectations of where bank rate will be, not over the next 2 or 3 years, but much further down the road, where we may have got back to a more normal situation for monetary policy, those expectations, I think, are consistent with the idea that what we might have thought in the past about the normal level of bank rate, a number close to 5, the new normal may well be a level significantly lower than that. This blue line here is an estimate of so-called forward rates based on index swaps. So it's in some ways a rather clean measure of the market expectation of where the level of bank rate itself might be going. So the expectation is that if you look 7 or 8 years down the road, we might have got to a level of bank rate of 3.5% or so, and perhaps then continue to stay there. There's another way of thinking about measuring what market expectations of the future level of bank rate might be based on gilt yields. That would give you slightly higher numbers, but still significantly short of the 5% level that people might have thought as normal in the past. I want to just say a few things before concluding about one factor which might muddy the water in terms of assessing what a neutral level of bank rate is, which is what happens to the balance sheet of the Bank of England. Should we expect the neutral level of the policy rate to be influenced by the size of the balance sheet of the central bank and the composition of the assets that it holds? The size of the balance sheet of the Bank of England, as I mentioned earlier, has increased very markedly over the past few years. Largely that's a result of asset purchases on a scale that I think most people would have considered inconceivable a few years ago. The bank has bought £375 billion of gilts. The corresponding liability on the Bank of England balance sheet is an enormous expansion in the reserves held by the commercial banks at the central bank. And we might ask the question, what might be the influence on what I've called the neutral policy rate of that larger balance sheet of the Bank of England potentially unwinding? Might we expect that to have a big impact? And there are 2 points I would like to make very briefly about that. The first is that the scale of that unwinding may well end up being short of selling most of the £375 billion of gilts for one pretty clear reason, namely that the commercial banks may well decide that for prudent reasons they want to hold much higher levels of reserves at the central bank than they used to think was prudent. If you go back just a few years in the UK and measure the holdings by the commercial banks in the UK of reserves at the Bank of England, plus assets that were likely to be liquid even in very stressed markets like Treasury bills and gilts, those assets relative to the balance sheet of the commercial banks in the UK were minuscule. I think a position that reflected a view widely held that the interbank market would always be liquid and function well, so why did banks really need to hold lots of assets that were potentially rather low yielding, had the benefit of being highly liquid that they could use in a crisis, but if they thought they could always borrow from each other, why would you need to hold so much of that stuff? That didn't used to be the view of banks if you go back 30, 40, 50 years or more, where they had quite a high proportion of their balance sheets in what I would call the safest possible assets, government bonds, reserves at the Bank of England. Those reserves at the Bank of England, as I've noted, moved up very sharply, partly as a result of quantitative easing. That was how we funded the asset purchases, through creating reserves. And my guess is that banks will want to hold very substantially higher levels of reserves for many years to come, because the perception of the probability that the interbank market may go wrong surely is different now from what it was in 2006, 2007, when it was probably considered to be in the realms of inconceivable, that the interbank market would freeze up and banks simply would not lend money to each other. And if you believe now that that kind of thing is a material risk, you probably do want to hold more reserves at the Bank of England. And if that is what banks want to do, and the Bank of England says, okay, we will let you do that, then the balance sheet of the Bank of England will end up being larger for potentially many years to come. And therefore, we shouldn't necessarily expect the balance sheet of the Bank of England to shrink back to where it was. Now, that's a proposition then about, should we think that unwinding the asset purchases and reducing the balance sheet of the Bank of England is an inevitable process? I suspect that the balance sheet of the Bank of England may well not go back to anything like where it was. I think there's, in some sense, a more fundamental point for believing that the decisions of the central bank on the size of its balance sheet and what it does with the gilts that have been purchased, there's a more fundamental reason for thinking that those decisions, to be taken over many years now into the future, probably don't have a very material impact on what I have called the neutral setting for monetary policy. And it's an argument I sketch out in some detail in the written version of this talk, but I'll just spend 1 minute sketching it out very briefly. The idea is kind of simple in a way, and it is this: that if financial markets are operating effectively, efficiently, and smoothly, then changes in the composition of the assets held on the central bank's balance sheet probably don't have an enormous impact on the pattern of yields. I think that the asset purchases that the Bank of England undertook on a very large scale in 2010 and then continued in later years as well, I think those purchases clearly took place in an environment where financial markets were not operating smoothly. They were to a large extent dysfunctional. And in that environment, I think there are very strong reasons for thinking that such large-scale asset purchases can have a very material impact on yields and economic conditions. But in more normal times, when financial markets are operating much more smoothly, I think changes in the composition and the size of the balance sheet of the central bank is likely to have a much smaller impact. And that's why I think one can, to a large extent, separate two questions, which is what might be the neutral level of bank rate as we look into the future, and what might happen to the balance sheet of the Bank of England. And I think of those two things as, to a significant extent, separate issues. Let me very briefly conclude. I think that the new normal for monetary policy will be a world in which bank rate will probably be, on average in the future, lower than a level that we used to think of as normal. Normal, as I say, in the past may well have been 5% or so. I think there are reasons for believing that that number may be significantly lower in the future. But I also think that the balance sheet of the Bank of England, in particular the stock of gilts that it holds, is not likely to be a major factor in determining what I've called the long-run neutral level of bank rate. A number I think is lower than what we used to think of as the old normal. I'm going to stop at that point, 'cause I've talked too much. I'm very happy to hear people's thoughts, comments, and try and address the questions. Shall I stay standing up here? It's probably easier.
Are you comfortable standing
I'm
there?
I'm very comfortable. Let me just get some water.
If you are, now who's going to ask the first question? Oh, I've got lots of... Do you want to say who you are? Well, start there.
I'm Bill Schomburg from Reuters. Do you foresee any situation where we could get back to 5% in the perhaps not immediate future, perhaps not the near-term future, but going further ahead? I know it's hard to look that far forward, but do you think that permanently we're now at sub 5%?
Well, I think that the factors that I've been talking about here, changes in perceptions of risk, perhaps differences in the spread between the safe rate that the central bank sets and the rates that households and companies face. I think the forces I've been looking at are things that are quite likely to prove persistent. And that's why I think there's an argument that whatever the neutral level of the policy rate set by the Bank of England is, I think for a sustained period that neutral rate may well be markedly lower than 5%. Now, I don't believe that what I've called this neutral level of monetary policy, the neutral policy rate, is fixed for all time. I think it does evolve through time, and some of the forces I've been talking about are clearly different now from what they were 10, 20, 30, 40 years ago. So I'm not arguing that the neutral level of policy rate will never be 5% again, but I think for a sustained period, there are reasons to think that it might be lower than 5%.
Question, yep.
Name's Nigel White, friend of mine, group, and I suppose most relevant to this talk, trustee of a pension scheme. My question is really, don't disagree with anything you said in terms of your analysis, but thinking about the second order implications of this, and in particular on the sort of almost the social policy aspects of it, if as a result of these lower yields and interest rates going forward, it affects people's personal perception of the need to save or indeed need to make pension provision, will that not in itself cause longer term potential problems? And how will that be addressed in a policy issue terms? And will that cause a sort of reversion back to the old order?
That's a very good question. Now you might think that if what I've called the safe real interest rate is going to be a markedly lower number now than it was 10, 15, 20, 30 years ago, that the incentive to save will be much smaller, and that will itself have macroeconomic consequences. Actually, I'm going to come back and say something a little bit about this analysis by Robert Barrow, the American economist. The reason in his model that the safe real interest rate gets driven down is that in a world in which people are more concerned about extreme bad events that might come along, that in itself makes them want to save more. And it's the increase in the savings rate, and in particular the mix of savings between risky and less risky assets. It's that increase in the savings rate and it's being skewed towards safer stuff is what drives what I call the safe real interest rate lower. So in the Barrow framework, you get both a significant reduction in what I've called the safe real rate going alongside an increase in the savings rate. Which sounds a bit perverse, because if you said to people, well, imagine a world in the future in which the rate of return on savings if you invest in safe stuff is a lot lower, what would you expect people to do? You might say, well, they're going to save less. But of course, what the mechanism in the Barrow thing is, what's driving the safe real rate lower is precisely that because people are more worried about bad events, they actually want to save more as a form of insurance against them. So I think that there's something to that argument, and as I say, in the longer version of the paper, I kind of sketch it out perhaps a bit more clearly than I can now.
At the back there, that side, yeah.
Mike Dix, Woodbine Asset Management, Haxley. Can I ask you, David, to be a bit more? Thank you. Can I ask you a bit more clarity around, whether you feel the shift is warranted? So in other words, you talked about a shift in perceptions and that could be persistent. But in the sort of Barrow world, in a sense, we were living in cloud cuckoo land because the facts that he's showing you are telling you the true probability is quite a bit higher than people perceived it to be.
Yeah.
In which case now we're living in the real world, and so it should be permanent, really, unless for some reason we go back to cloud cuckoo land. And then in a sense related to that is, but driving the Barrow stuff is what you might call a shock probability of something coming along causing a crisis. And then related secondly to that is the response of policymakers. And isn't surely now the situation one where we not only have the experience of Japan to show that policymakers' reactions perhaps aren't up to the task, but also the toolkit probably isn't up to the task if we do get the sort of shocks that we now know are more common than we perhaps perceive them to be in the past. So I wonder how much, in a sense, do we have to rethink the policy toolkit in a rather more fundamental way than we are currently talking about.
On the first question about were we in cloud cuckoo land if we thought that events such as we've seen in the last 5 years were 1 in 1,000-year events, I mean, I think partly the answer to that must be yes. I mean, I certainly, I don't know how you felt, but I mean, before 2007, certainly before you get to the autumn of 2008, I would have thought that the probability of the banking system in the UK coming very close to total meltdown and that generating a collapse in confidence and a catastrophic decline in GDP followed by 5 years of virtually no growth. Somebody had said to me, what's the chance of that happening, say in 2006? I'd have said, that's not going to happen. We now know how to run financial systems. We don't get into those kind of problems anymore. And I don't think that anymore. So, I know my own personal perceived probability of what's the chances of this kind of stuff happening has gone up a lot. I mean, I don't know how representative I am, but and my own personal assessment of the chances of this kind of stuff happening, I think, is now going to be permanently higher for the rest of my life than it was in 2006. So I think that will have a lasting impact. On the toolkit of policy, I think the toolkit. I mean, we'll see how adequate it is, but I think it is a bigger toolkit anyway. And you will know as well as I do that there is now the new nasty jargon across the world is macroprudential policy tools, using capital requirements, varying them, and the Financial Policy Committee in the Bank of England has a range of tools to use to try and preserve financial stability. Well, that committee wasn't there before. We didn't think of using capital requirements to try and control overheating parts of the financial system. And the average level of capital requirements themselves, is moving up quite markedly relative to where we used to be. So I think the toolkit is bigger.
There's a question at the back, not William Keegan, next to Dave Rand. Oh yes, yep.
Francis Breed and Queen Mary. There was I think there were at least three issues with what you've got here. First, I thought there was a bit of statistical sleight of hand to say that a 10% fall in GDP relative to trend over 5 years is the same as a 10% fall in GDP in a year. I mean, that clearly is a much higher probability event than that. The second point, we had the Great Depression, and then we had a war, and everything went back to normal again after that. So in comparison to that, this is actually a rather minor event in the grand scheme of things. And then I think thirdly, and most importantly, this is, your prediction would be that risky assets would do very badly in this scenario. But in fact, if you look what's happened, housing, and equity, which are the riskiest assets, are behaving as if they're being discounted by a very low real interest rate. So the risk premium on the risky assets doesn't seem to have gone up in the way that you would have predicted. And I think your stuff with the corporate bonds, I mean, that seems to be mainly credit risk rather than actually genuine, sort of market risk. So it doesn't seem that that's consistent with your story. Anyway.
You always get the meanest questions from people you've written a book with. So thank you very much. Thank you very much, Francis. Remind me not to write a book with you again. Okay, no, they're good. They're good questions. Sleight of hand about saying that. Well, we've seen a 20% fall, 15% fall, say, in the level of GDP relative to trend, but it's over a period of 5 years. I mean, you're right. I should say, however, that the particular statistical model I was talking about was one in which shocks come along and there's no serial correlation in the shocks. I know you'll understand this point. And therefore, in the rather simplistic statistical model I fitted to the data, when you got a bad shock, it had an impact on GDP and all the effect of the shock came immediately. And now it was a permanent shock, so it stayed there, but it all came through in one hit. Now, of course, actual shocks that hit economies, probably, the shock comes along and it has a lasting impact. So there's a correlation in the shocks over time. So I think that a more realistic real-world counterpart to how bad is the shock we've seen does indeed think of the shock, the financial shock, as not something which happened in a particular month of a particular year, but then has actually had a lasting impact for some years. So that's why I've kind of added together all the nastiness, if you will, that's hit the UK in the wake of the financial crisis and said cumulatively maybe it's not 15% of GDP. You said that, well, we had the Second World War and then things went back to normal. Well, really? I mean, the UK, the structure of the UK economy and the debt it accumulated in the war and what happened to overseas assets owned by the UK, boy, that, they did not go back to normal. So I'm not quite sure about the description of we had the war, we had the Depression, then the war came along and, everything got back to normal quite quickly. So, you're going to accuse me of being cavalier. I'm going to accuse you back of being cavalier, if that's your description. So I can't. What was the third? The
risky assets. Why risky assets not fact?
Right. I mean, you're right that if you think of housing as a risky asset, if you think of equities, which clearly are risky assets, then their values, I mean, certainly in nominal terms, have recovered quite a lot in the UK. So in nominal terms, someone will put me right if I've got these numbers wrong. I'm guessing sort of in nominal terms, the level of average house prices in the UK is probably not far off where it was before the crisis now. Of course, in real terms, given that was, if the peak was, I don't know, mid-2007 or something, I mean, that's getting on for 7 years ago. So in real terms, they are a bit lower. But nonetheless, they have clearly bounced back, and so have equity values. Of course, what it's taken to get that is extraordinarily expansionary monetary policy, and very much not a neutral level of policy. So I think the reason why risky assets have regained quite a lot of their value is that central banks have absolutely bent over backwards to try to drive those asset prices up by setting monetary policy at the most expansionary setting, certainly in the UK, in the history of the country.
Can I just follow up on that, David? Because if you're right, which I'm sure you are, and I've got every confidence in the Bank of England, monetary policy will be set correctly, and things will go very well. If actually, you suffered from sort of excess adaptive expectations and you've let this crisis completely take over your thinking about the future, there's a risk that actually you'll set monetary policy too loose. And now, I wouldn't argue this because I'm a great supporter of what the bank's doing, but there are people out there who will argue that inflation has been far too high for too long, that when you set a target for unemployment, which you thought would take 4 years to get to, you got there in 6 months. That there's something that the Bank of England hasn't quite got it right. Now, just tell me why I'm wrong.
I mean, the 7% number was never a target. We certainly didn't set a target for unemployment. What we said was that until unemployment fell to 7%, we would definitely not be increasing interest rates, and that once we got to 7%, we'd have a good hard look as to what the economic situation is, and then make a judgment about what the right setting of policy is. Well, of course, actually, we haven't got to 7%.
I know, exactly.
So, I mean, we're at 7.2. I mean, however, it's certainly true that the fall in unemployment since we came out with that form of forward guidance back in the summer, the fall in unemployment has been more than we thought likely. I mean, in itself, that's a pretty good thing. So, you know, I don't think of that. I mean, it certainly wasn't a target. And we said we'll be disappointed if unemployment gets to 7% before 2016. I mean, that was never part of the message. So actually, it's a good thing that unemployment has come down and that actually GDP growth has been a bit stronger than we thought back in the summer. I mean, the decline in unemployment has been disproportionately greater than you would anticipate given what happens to GDP, which is just the flip side of productivity performance being very poor. Now, that may turn out to be somewhat transitory. I'm probably at the more optimistic end of the spectrum on the Monetary Policy Committee in thinking that there is scope for the level of productivity to bounce back, and we'll see. I mean, in terms of where inflation has been, yeah, I'm painfully aware that, you know, most of the time that I've been on the Monetary Policy Committee, I joined the committee in the first part of 2009, around about the middle of 2009. For nearly the whole period that I've been on the Monetary Policy Committee, we have significantly overshot the inflation target. I think you have to delve into the reasons why that happened and what was the appropriate policy response. And to a significant extent, it was a combination of a big depreciation in sterling in 2008, which is actually quite welcome in terms of what it did for competitiveness, but certainly added to inflation pressures for a few years after that. Then a substantial bounce back in world commodity prices, which had fell, you know, fell very, very sharply in the early part of 2009 when people thought that capitalism was over. And then they thought, well, maybe it's not. And so commodity prices just increased enormously, particularly in sterling terms, given what had happened to the exchange rate, increased enormously in 2010 and 2011, and a perfectly understandable decision by the government at the beginning of 2011 to increase the VAT rate. Now, we could have sat in the Bank of England and said, well, we don't care why inflation has moved up to 4.5%, 5%. We just perceive that it has, so the right strategy must be to jack up interest rates and try and bring it back down to the 2% level as quickly as we possibly can. And I think that would have been a catastrophic strategy in an environment where growth was still virtually zero and we hadn't had any recovery from the terrible year of 2009. And I mean, I would say this, wouldn't I? But I think a better strategy was to have some patience with bringing inflation back to the target level, because that was the way to try and support a recovery in demand in the economy. And the likelihood was that the forces that had driven inflation so far above the target would prove to be somewhat transitory, and that we could get back to the target level without dramatically tightening policy. Well, where are we right now? Inflation is 1.9%. The bank rate is still at half. We've had a bit of a recovery, thankfully, but I still think there's some slack in the economy, and the recovery is a relatively recent phenomena following 5 years of very poor economic outcomes in the UK.
And it is, you should be congratulated on getting back to target. Now, we've got time. We're supposed to finish 7:45. I'm going to allow 2 more questions. I'm going to take a question from Mr. Keegan at the back and from Mr. MacDonald here.
Thank you, Rick.
Yeah, why don't you start and then we...
I was intrigued in your chart about the spread between bank rate and lending to...
Yeah.
The spread between bank rate and the lending to households and mortgages.
Right, yeah.
And you said that at one point it went down to sort of 0.5%, and today it was something like 2.7%.
Yeah.
And you also said, and correct me if I misinterpreted you, that you thought that over the years that would sort of go back towards the figure at the very top, the one up to 1996 of 1.2.
Yeah.
Now, granted that many lenders might agree with what you were saying in answer to a previous question, that it would seem quite reasonable to expect at some point in the future, some pretty bad economic outturns. Why should lenders expect to move that figure from, or why do you expect it to go from 1.9 to 1.2 when in practice, after the great disasters of the last few years, you would expect them to be very prudent and not look to bring that spread down?
Yeah, I think part of the reason is that I suspect many banks are still going through this sort of slightly painful process of restructuring their balance sheets, trying to build up their equity capital levels to what they would consider to be prudent and more sustainable levels for the long run. So in that transition, maybe that spread is a little bit higher than it might be once they've made the transition to a more desirable balance sheet structure. That's a slightly speculative thought. I think there's another reason why why the spread might be unusually high over bank rate relative to where it might get to. So that's why I think we might get back toward that number rather than stay at this number. And it's because with bank rate so very low, banks clearly can't charge negative interest rates on their deposits. So they've been squeezed in some sense on the usual margin that exists between bank rate and the rate that they can charge, the rate that they will pay rather on their deposits. So they're being squeezed a little bit on that margin because they can't charge a negative interest rate and bank rate is very low. So as bank rate does move back up and gets off the floor, I think they can get a bit more of a margin, if you will, on deposits relative to bank rate, and that will allow that margin to come down a little bit. I'm not terribly confident about all that. You may well be right that actually that is indeed the new normal spread. I've got a slight feeling that perhaps the new normal is a bit nearer that number than that number, but we'll see. I mean, you may well be right.
Thank you, William Keegan. Going back to an earlier question, I think it's very risky indeed to write books with other people, in my experience. But my question relates to a chart that's disappeared. It seemed to me from this distance that the liquidity ratio was pretty close to zero at the run-up to the crisis. It was very low.
Yeah.
You've talked about it going up. Now, in the days when Mr. MacDonald and I were working on the Financial Times in the late 60s, it was more like 29 or 30%, I think. Yeah. What would your ideal liquidity ratio for these banks be?
I mean, thankfully, as a member of the Monetary Policy Committee, that particular question is handed over to other people in the bank. But I'm not trying to dodge the question, though. I mean, I think what's acceptable in terms of liquidity is clearly now a very different number from what we thought was acceptable in 2005 and 2006. I mean, in 2005, 2006, I think I'm right in saying that the level of reserves held by the commercial banks at the Bank of England was of the order of 20 or 30 billion pounds, which was indistinguishable from zero in that chart relative to the size of the balance sheets. Now the stock of reserves that the commercial banks hold at the Bank of England is not far off 300 billion. So it's, order of magnitude 10 times larger. I suspect that even if there weren't much tougher liquidity rules in the world now as there were then, and there are, but even if there weren't, just left to their own prudent commercial decision making, the banks would want to hold much more of Treasury bills, short-dated gilts and reserves at the Bank of England than they used to, because something happened which they thought was inconceivable, and now they know it is not inconceivable. Okay. But the liquidity regulations will force them to do it, even if they wanted to go back to the old world, they won't be able to.
No, I've got three very important announcements. First, the next meeting of the Marlin Group will be Dame Tessa Jowl on Sure Start, its challenge to the conventional machinery of government. I don't know what date that is on. Does anybody? Anyway, you will be told. 26th of March. Secondly, and we're getting to the important bit, Drinks are going to be available in the foyer of the main Queen's building. That's sort of round there, but if you don't know where the main Queen's building is, do ask. And finally, and most importantly, can I thank David for a fantastic talk. He's done really good analysis, and you know, I can't underline too much actually the job David has done in helping us get out of this appalling mess we found ourselves back in 2009. So can you join me in giving David a very good round of applause?
Thank you very much.